If you've looked at the value sector of the stock market lately, you've probably seen some prices that look like absolute steals. Stocks down 60, 70, or even 80% from their 2021 highs. Your instinct is to buy the dip. You think, surely this company can't go lower. But in 2026, that instinct can be fatal. We are currently living through what we call the zombie epidemic. For 10 years, near-zero interest rates allowed companies with zero profits and massive debt to stay alive. But now, with the Fed holding rates steady at 3.75% and the One Big Beautiful Bill Act changing the way corporate interest is taxed, the life support has been unplugged. Welcome to Principal and Profit. We help individuals understand how to build wealth through value investment principles that help secure a future where financial stress is nothing but a theory. Today, we aren't looking for cheap stocks. We are looking for fortress balance sheets. We are going to use engineering-grade metrics to screen for quality so you can ignore the quantity of deals and focus on the security of your principal. Let's look at the standard. The first tool in our Fortress Kit is the debt-to-equity (DE) ratio. This measures how much a company is leaning on borrowed money versus its own skin in the game. In the old world, a debt over equity of 1.5 or 2.0 was considered normal. But in 2026, those numbers are a red flag. Why? Because the cost of servicing that debt has tripled. If a company has to refinance its 2021 debt at 2026 rates, its profit margin will vanish instantly. So what's the principal and profit standard? We look for a debt-to-equity ratio of less than 0.8. If debt over equity is below 0.8, it means the company owns significantly more than it owes. It has the margin of safety required to survive sticky inflation. When their competitors are panicking about interest payments, the Fortress Company is using its excess cash to buy those competitors at a discount. That is how you turn a bear market into a wealth-building event. Next, we have to talk about the accounting lie. On every earnings call, CEOs talk about net income, or adjusted earnings before interests, taxes, depreciation, and amortization. In 2026, we ignore those. Net income is a filtered Instagram photo. It's what the company wants you to see. Free cash flow, or FCF, is the security camera footage. It is the cold, hard cash left over after the company pays for its operations and its physical upkeep. The filter. We are looking for free cash flow yields of 5% or higher. If a company is growing its earnings, but its free cash flow is shrinking, they are likely using accounting tricks or aggressive capital expenditure that isn't paying off. A Fortress Company generates more cash than it knows what to do with. The interest coverage ratio, or ICR, tells us exactly how many times a company can pay its interest expenses using its current operating profit. The standard. In the 2010s, an interest coverage ratio of 3 was fine. In 2026, we demand an interest coverage ratio of 6 or higher. If a company's interest coverage ratio is 2, and their revenue drops by just 10% during a consumer slowdown, they can no longer pay their lenders. They become a zombie overnight. A company with an interest coverage ratio of 8 can survive a 2026 recession, a geopolitical shock, and a 20% drop in revenue without even sweating. That is the peace of mind we are engineering. Let's look at a hypothetical example. Company A is a hot AI growth stock. It has debt over equity of 3.0 and an interest coverage ratio of 1.5. If their AI chip delivery is delayed by 3 months, they go bankrupt. Company B is a boring medical equipment manufacturer. It has a debt over equity of 0.4 and an interest coverage ratio of 12. They haven't had a viral headline in years. But while Company A is diluted by a secondary share offering just to keep the lights on, Company B is raising its dividend for the 22nd year in a row. So, which one do you think belongs in your Fortress portfolio? Our answer? The one that protects your principal while generating profit. Quality is not an accident. It is a choice. In 2026, the quantity of stocks in the market is higher than ever, but quality is at a 30-year low. By applying the 2026 standard of the debt-to-equity ratio, the free cash flow filter, and the interest coverage stress test, you aren't just investing, you are performing an engineering audit on your future. Stop buying the dip. Start buying the fortress. Click on the like button if you're choosing quality over quantity this year. Subscribe to stop being a victim of the market and start being an architect of your wealth. Share this with someone who might benefit from this information. I'll see you in the next one.